Developing marketing strategies. A marketing plan is a broad set of guidelines as to how the firm is going to accomplish its strategic goals. It is a blueprint for the future course of action, and it guides all the marketing actions of the firm. A successful marketing organization needs to deliver a good value proposition and develop market-oriented strategic planning to make a value offer unique and adaptable to the changing environment. In this lesson, we will study marketing planning, cycle of planning, implementation and control, strategic decision making. It follows from the previous slide that after studying this lesson, you should be able to understand planning, analyze characteristics of good marketing plan, analyze the importance of marketing planning, analyze the strategic corporate planning by top management, analyze the resources assigned to strategic business unit, analyze the strategic planning at business unit level, analyze the industry and competition, understand concepts of competitive advantage and core competency, know how overall marketing plan is designed. Planning is the process of envisioning the future, establishing objectives and goals for the firm, designing organizational and marketing strategies and tactics to be implemented at different points of time in future to achieve the goals. It involves analysis of perceived opportunities and threats, evaluating various alternatives and selecting the best course of action to achieve organizational goals. Planning goes beyond analysis and helps in predicting the future and in devising means to adjust to an ever-changing environment. As we move down in the management hierarchy, the focus of planning also narrows down. While at the middle level, managers are involved in business planning, at strategic business unit (SBU) level, the lower level management do operational planning. The same is shown through this table. The importance of marketing planning can be summarized by the fact that it helps in avoiding future uncertainties, management by objectives, achieving objectives, coordination and communication among the departments, control, and it also helps the customers in getting complete satisfaction. Corporate planning is a term used to denote a formal, comprehensive and systematic appraisal of internal environment to achieve organizational objectives. It helps in the formulation of plans, strategies and policies on the basis of allocated resources. It is a systematic as it covers the whole planning process in a logical and sequential manner. Top management prepares statement of mission, objectives and goals that play the role of a framework within which divisions and business units prepare their plans. They are the guiding force for the organization and express the reason of being in business and what specific goals the firm is pursuing at a given point of time. A mission statement should define the scope of the industry within which the firm will operate, the range of products and applications that a firm wishes to supply, the range of core competencies, etc. The next step in corporate planning process is setting up of corporate objectives. Corporate objectives help in identifying and achieving the desired future positions or destinations. Once the organization mission, objectives and goals are set, they will provide a framework for determining what kind of organizational structure and business models are a best fit for the organization's marketing efforts. The organization structure for a single product will be simple as it can be designed by management function or geographic territory. But in the case of multi-product organization, the structure can be very complex. So companies prefer establishing strategic business units, SBUs. An SBU is a distinct business unit of the business organization in form of a subsidiary company, department, division or product line with a specific product market focus, an independent authority and responsibility of the manager to take business decisions. The purpose of dividing the whole business to different independent strategic business units is to allocate the total firm resources among various SBUs. The Boston Consulting Group's Growth Share Matrix or BCG matrix is the most popular growth share matrix model. It involves SBUs being positioned in a matrix on the basis of market growth rate and their market share, relative to that of larger competitors. Resources are allocated to business units according to where they are situated on the grid as cash cow, star, question mark and dog. Cash cow is a business unit that has a large market share in a mature, slow-growing industry. Cash cows require little investment and generate cash that can be used to invest in other business units. Star is a business unit that has a large market share in a fast-growing industry. Stars may generate cash but because the market is growing rapidly, they require investment to maintain their lead. If successful, a star will become a cash cow when its industry matures. Question mark or problem child is a business unit that has a small market share in a high growth market. These business units require resources to grow market share, but whether they will succeed and become stars is unknown. Dog is a business unit that has a small market share in a mature industry. A dog may not require substantial cash, but it ties up capital that could be better deployed elsewhere. Unless a dog has some other specific purpose, it could be liquidated if there is a little prospect for it to gain market share. General Electric multi-factor portfolio matrix approach has a variety of names, including the 9-cell GE matrix, GE's 9-cell business portfolio matrix, and the Industry Attractiveness Business Position Matrix. It was also developed at General Electric with the help of McKinsey & Company, a consulting group. Each of an organization's business is plotted in the matrix on two dimensions: industry attractiveness and business growth. Each of these two major dimensions represent a composite of a variety of factors. The two dimensions make good sense for strategy formulation, because a successful business typically operates in the attractive industry where it has a particular business strength required to succeed. Both ingredients are needed to produce outstanding performance through substantial advantage. The Arthur D. Little model is based on competitive position and stage of industry maturity. The competitive position is recognized in 5 main categories: dominant, strong, favorable, tenable, and weak. The second dimension of the model, the stage of industry maturity, ranges from embryonic to aging. The combination of competitive positions and industry maturity provides the basis of determining the SBU's strategic conditions and subsequently the identification and evaluation of strategic options open to the company. A portfolio model helps in identifying business opportunity within the existing business units and relocating investments for overall portfolio. But firms need to develop or acquire new businesses to achieve the desired results. If an evaluation of performance of an existing portfolio does not fulfill the corporate goal, then firms may decide to go for acquisition and new business development. The company operates in a particular product market and targets certain marketing goals. It would like to penetrate further in the same market to arrive at economy of scale of operation. Deeper penetration is possible both in geographic and demographical terms. In a national market, if it is covering few states, it would like to cover more states by increasing scope for geographic coverage. Companies can also grow by integrating its business operations. When a company integrates its supply function with core business, this is called backward integration. Instead of relying on a supplier, the company may decide to go for self-production. Similarly, it can go for forward integration by taking over some of its retailers and wholesalers. They can also take over some of their competitors and complementary organizations and grow in business. This is called horizontal integration. Diversification growth strategy is followed when firms discover better opportunity growth beyond their current business. If there is a good business opportunity with similar operations to current business, companies find this diversification as more feasible. At times, companies need to downsize the business to increase efficiency and profitability for the firm. Downsizing helps in increasing production and marketing efficiency, reduction in costs, and efficient utilization of manpower and production process. A business unit which does not have future potential needs less resource allocation and should slowly phase out of similar businesses for long-term growth and success. After the corporate plan is made, companies go for business unit level planning. The business unit level plan comes out of corporate plan. There are 6 steps involved in business unit level strategic planning. At first, the SBU must analyze the industry and competition. The firm needs to conduct a SWOT analysis to find out the strength, weakness, opportunity, and threat analysis for a business unit. A company deliberately chooses a particular strategy depending upon its strengths and goals set for the business unit. While goals indicate what is to be achieved, strategy is the game plan used to achieve these goals. Michael Porter has proposed 3 generic strategies that a firm can follow. They are cost differentiation and focus strategy. Companies follow cost strategy when they can produce and distribute goods and services at the lowest possible cost compared to competitors to win a larger market share. Companies can differentiate their offer on a particular dimension, which is a significant criterion for customers in making a decision. Companies may pursue focus goals in which they concentrate in a narrowly defined business or serve a closely defined market segment. Once the business unit planning is over, the marketing manager should develop a detailed supporting program. These programs are purely functional plans to execute the strategies. Marketing managers need to develop a marketing plan which should include cost estimates, budget allocations on various functional activities, and link the investment with likely returns to decide whether it's worth executing a particular program. For successful business planning and implementation, it is important to monitor and evaluate the execution at different points of time. Firms have designed milestones and targets to measure the performance, and if they find a gap between what was planned and the results of the plan, they need to take corrective actions. This feedback flow also helps in finding out the validity of assumptions on likely market response to the marketing strategy. A competitive advantage is an advantage over competitors gained by offering consumers greater value, either by means of lower prices or providing greater benefits and services that justify higher prices. Core competencies are those capabilities that are critical to a business achieving competitive advantage. The starting point for analyzing core competencies is recognizing that competition between businesses is as much a race for competency mastery as it is for market position and market power. The planning process must begin with setting down the corporate objectives and should be followed through with strategy and plan for each separate function. The first step in marketing planning process is setting down marketing objective and policies. The objectives here must be only the long-term objectives, which can be fixed in terms of sales and revenue turnover. The second step is designing the marketing system. In the marketing system, a company has to design or define each function with its contribution. The third step is to develop separate objectives, programs and strategies for each function, like new product development function, pricing decisions, distribution function, promotion function, so that they can be assessed for target purpose and the broad objectives. If any function cannot meet its objective, the latter have to be modified for that functional area. The fourth step is drawing of detailed plans for each function for a shorter period, that is a quarter, half a year or a year. It will be helpful in defining responsibilities, timings and costs needed to achieve the short-term objectives. The fifth plan is merging the marketing plans into organizational plans. A marketing plan is to be developed in detail on the basis of functional plans and programs. Further, detailed plans will act as guide for a marketing objective and marketing strategies. Functional plans are instruments which translate grand strategy to marketplace reality. If the functional plans are not drawn properly, the marketing strategy may turn into failure at the marketplace. The marketing plan should be formalized as a written document. A standard marketing plan should contain elements. Now let's check if we've understood the various concepts discussed in this lesson clearly. Corporate objective help in identifying and achieving the results. Future positions or destinations. Strategic planning focuses on day-to-day operations of the business. Integration is a strategy whereby a marketer offers a product that is unique in the industry. Before we end, let us briefly revise what we've studied till so far. Marketing planning of an organization is planning for the organization's revenue-earning activities. Market-oriented strategic planning is necessary to make the organization's, its resources, and its intent of being in business fit with the evolving environment. It starts with setting down the corporate objectives and should be followed through with strategies and plans for each separate function. Marketing provides inputs for strategic planning. Strategic planning starts at the established business mission, objectives and goals of the organization. Establishing SBUs, assigning resources to the SBUs and developing planning for business growth. Resource allocation to each of the SBUs depends on the market attractiveness and growth potential of the SBU. Marketers use portfolio models like Boston Consulting Group Matrix, Multi-Factor Portfolio Matrix of GE, and Arthur D. Little Portfolio Matrix for evaluating SBUs and assigning resources to each one of them. Business growth planning is possible in various ways. Marketing planning is a forward-looking exercise which determines the future strategies of an organization with special reference to its product development, market development, channel design, sales promotion, profitability, etc. A good marketing management process involves identification of marketing opportunity, selection of target market and positioning for company's offer, developing and managing the marketing program through product, price, place and promotion plans and developing systems, organizations and procedures to implement, control and evaluate the marketing program.